Hello guys, this is Rita Kumari. In this video we will know about what is capital budgeting and what are its features. Let us know first what is capital budgeting. Capital budgeting is a process of making investment decisions in long-term assets. It is a process of deciding whether or not to invest in a particular project, as all the investment possibilities may not be rewarding. Thus, the manager has to choose a project that gives the rate of return more than the cost of financing such a project. That is why he has to value a project in terms of cost and benefit. Now let us see some of the categories of projects that can be examined using capital budgeting process. The decision to buy a new machinery, expansion of business in other geographical areas, replacement of an obsolete equipment, new product or market development, etc. Now, capital budgeting process. It includes idea generation, which means generation of good investment ideas. Analyzing individual proposals, which means forecasting cash flows of each project to determine its profitability. And planning capital budgeting. This means giving priority to profitable projects. Lastly, monitoring and conducting a post-audit, which means comparing actual with the projected results and systematic post-audit to find out systematic errors in the forecasting process and hence enhance company operations. Now let us see some of the techniques of capital budgeting. This includes traditional methods. In traditional methods, we determine the desirability of an investment project based on its useful life and expected returns. Furthermore, these methods do not take into account the concept of time value of money. In traditional methods, we have payback period method. It refers to the number of years it takes to recover the initial cost of an investment. Thus, if an entity has a liquidity issues, in such a case, shorter a project's payback period, better it is for the firm. It also includes average rate of return method, that is ARR. In this, the profitability of an investment proposal can be determined by dividing average income after taxes by average investment, which is average book value after depreciation. We have discounted cash flow methods. In these methods, we take into account the consideration present and future flow of incomes. Thus, discounted cash flow methods take into account both profitability and time value of money. Under discounted cash flow methods, we have net present value method, that is NPV. NPV is the difference between the present value of cash inflows of a project and the initial cost of the project. As per this technique, the projects whose NPV is positive or above zero shall be selected. We also have internal rate of return, that is IRR. IRR is the discount rate that makes present values of a project's estimated cash flows equal to the present value of the project's estimated cash outflows. If IRR is greater than the required rate of return for the project, then accept the project. And if IRR is less than the required rate of return, then reject the project. Now let us see some of the importance of capital budgeting. It helps in the calculation of future cash flows. It helps in the long-term goals of the organization. It controls expenditure. It helps in permanent decision-making. It helps in wealth maximization. It helps in flow of information within the departments. Protection to the large funds involved. Protection against future risks. New opportunities in the market. And it helps in understanding the complications of the projects. So that's all in this video. Hope you like it. Thank you.